The current live stock price for SoFi Technologies, Inc., trading under the ticker SOFI on the Nasdaq, sits at $24.63, reflecting a movement of down $0.28 or a decline of approximately 1.13% in today's session as of the latest real-time data. This slight but persistent dip keeps the stock anchored near the bottom of its recent trading range, a movement that is immediately striking because it goes against the aggressive institutional accumulation we've seen in the most recent 13F filings. The expectation, particularly among the retail crowd, has been that SoFi's stock would ride the tailwinds of its recent stellar quarterly earnings report, which demonstrated accelerating member growth and an impressive improvement in cross-selling across their product ecosystem, coupled with the long-awaited launch of their in-app crypto trading re-entry. However, the reality is a market that remains extremely sensitive to rate-sensitive financial names. And this current dip is less about a fundamental deterioration in SoFi's business, and more about profit-taking and broader macroeconomic nervousness amplified by a high beta. The initial reaction to the positive earnings was strong, pushing the stock up, but the current consolidation, or perhaps mild retracement, is a clear reminder that positive company-specific news often gets swallowed by sector-wide or macro pressures, especially when a stock has already seen a significant run-up of nearly 70% over the last year. The general belief about SoFi is that it's the definitive next-generation financial powerhouse, a one-stop-shop digital bank, poised to dismantle the legacy financial structure, using its national bank charter to gain a low-cost funding advantage via deposits. This narrative focuses heavily on the technology platform, Galileo, and the massive growth in member count. However, the contrarian, or at least the deeper take, challenges this by pointing to the valuation. The company's forward price-to-earnings ratio is still elevated, significantly higher than the industry average. The core challenge for SoFi's valuation is proving that its rapid top-line growth can translate efficiently into sustainable GAAP profitability, something that has been elusive for many fintech firms. The current stock movement, oscillating heavily in a tight range, suggests that while the market respects the growth narrative, it's also demanding concrete evidence of margin expansion and less reliance on high-interest personal loan originations, especially as the macroeconomic picture threatens credit quality. Examining the recent stock movement, the daily swings have been characterized by elevated, albeit choppy, trading volumes. The average daily volume is typically around 74 million shares, but we've seen spikes significantly above this, particularly following the crypto relaunch announcement and analyst price target adjustments, which have moved both up and down, creating a tug-of-war. Institutional activity, which is a key driver of mid-term stock trajectory, presents a complex picture. Recent 13F filings indicate significant net accumulation. Large institutions like JP Chase have drastically increased their position, alongside others like D.E. Shaw and various Vanguard index funds. This institutional vote of confidence is a strong countersignal to the current intraday weakness, suggesting that long-term focused institutions are buying dips and positioning themselves for the longer horizon based on the successful bank charter model and cross-selling data. The stock is exhibiting classic high-growth stock behavior in a volatile market. Quick rallies on good news, followed by quick retracements as large funds de-risk or rebalance. And all the while, smart money institutions are using these pullbacks as accumulation points, slowly increasing their share count without driving the price up too fast. This institutional patience is one of the key underappreciated realities the retail audience should be tracking. The business model of SoFi Technologies is built on a financial services productivity loop that consists of three main segments: lending, financial services, and technology platform. The lending segment remains the primary revenue driver, offering personal loans, student loan refinancing, and home loans, all characterized by their use of proprietary underwriting models to target a high-quality, high-earning demographic. The acquisition and integration of the National Bank Charter, which allows SoFi to use cheap member deposits to fund their loans, is the structural engine that dramatically lowers their cost of funding and is the linchpin for their push towards sustainable profitability. The financial services segment, encompassing SoFi Invest, brokerage, robo-advisor, and the SoFi credit card, is the growth driver for membership and the key to the cross-selling strategy. Their success here is measured not just in new members, but in the average number of products per member, which continues to climb. Finally, the technology platform Galileo provides core processing and program management services for other fintechs and institutions, giving SoFi a diversified B2B revenue stream that is less sensitive to credit cycles than its lending business. This multifaceted structure is the core reason for the optimism, but the heavy lifting of the lending segment in the face of persistent high interest rates is where the market tension lies. Moving to the critical element of short-selling awareness. SoFi has been a persistent target for bears, and the data remains compelling. The latest reported short interest is significant, standing at approximately 110.28 million shares sold short, which translates to a short interest as a percentage of float of around 9.31%. This figure is not excessively high in the context of meme or speculative stocks, but it is notable for a company aiming to be seen as a mature financial institution. The days-to-cover ratio is relatively low, around 1.32, which suggests that while there is short pressure, a major short squeeze scenario might require a significant unexpected catalyst and volume spike to be sustained. The short thesis is straightforward. It's a bet against the company's ability to execute on its bank-like efficiency while maintaining its high-growth fintech velocity. Bears argued that the high valuation is unwarranted given the historical losses and potential credit risks embedded in the loan book, especially if the macroeconomic environment worsens. They essentially view SoFi as an expensive, glorified lender in an increasingly competitive space. Investors need to pay close attention to the short borrow rates, which have been relatively low recently, hovering below 1%. Suggesting that while the conviction of some short sellers is strong enough to maintain their positions, the cost to initiate a new short position hasn't spiked dramatically enough to signal immediate panic among the shorts. However, the off-exchange short volume ratio, which has been reported near or above 30% on recent trading days, is a figure that retail investors actively discuss and is worth monitoring for potential dark pool activity. For investors, the actionable insight here is to use the short interest data as a sentiment indicator, not a trade signal. Find the most recent short interest data directly from NASDAQ, which is reported twice a month, and look for sharp, sustained changes. A sudden drop in short interest would signal capitulation from the bears, which could be bullish. A significant spike in the days-to-cover ratio, perhaps above 3 or 4, would increase the likelihood of a powerful short squeeze on positive news. What's your take on the rising short interest? Smart money or manipulation? The sentiment surrounding SoFi in the modern retail investor space, particularly across platforms like Reddit and X, is a mix of zealous long-term conviction and frustration over the stock's volatility. Discussions often center on the long-term vision articulated by CEO Anthony Noto, the goal of being a $55+ stock by the end of the decade, and the clear-cut wins, such as the high-yield savings account rates and the seamless product integration. However, there's palpable frustration, with many retail investors being bag holders from the SPAC highs, who are now looking for the stock to move past the mid-20s resistance. There's an active debate about the perceived lack of transparency regarding the specifics of the Galileo platform's customer metrics and its exact contribution to the bottom line, a common request for clarity across fintech names. The community is generally supportive of the brand's customer service, with many personal anecdotes about successful loan refinancing and the app's ease of use, which reinforces the long-term customer acquisition argument. This retail base is a key factor, as their coordinated buying during dips can provide a temporary floor for the stock price. The future outlook for SoFi Technologies is intrinsically tied to two major macro factors and one company-specific catalyst. First, the macroeconomic environment. Any sustained indication that the Federal Reserve is nearing the end of its rate hiking cycle or an eventual pivot to cuts would dramatically boost SoFi. Lower rates reduce the cost of capital for their lending segment and make their debt products more attractive, which is a powerful lever for profitability. The stock's performance is currently being held back by the persistent higher-for-longer interest rate narrative, a reality that the market has continually underestimated. Second, the success of the technology platform